Hey everyone, Alex Wilson here. Welcome to the Real Wealth, Real Estate podcast videos. My name is Alex Wilson, broker owner of Remax Wealth Builders Real Estate. And I'm going to tell you something impactful. You're going to die. And why that's impactful is I want you to understand two concepts. There are two finite items out there. Number one, time. Number two, land. And when you combine land and time, you can build substantial wealth. I've done it myself, and I want to show you how to do it too. And today, my first guest on this podcast, Real Wealth Real Estate, is Amit Puri, my go-to mortgage broker for my properties. Because everything I tell you how to build a multi-million dollar portfolio, you're going to need to get mortgages. And people get really scared of that, concerned about that. Can I do that? Amit, let's get you on right now, and I'm going to ask you a question that you've answered to me many, many times. Amit, is he on now, Scott? Gonna look at him? Good. Amit, who can get a mortgage?
Everybody. Just depends which rate and what bank.
Exactly. So, Amit and I have been working together for a long time, and I can tell you, I've gotten every type of mortgage. You get the A lender mortgage, which everyone's familiar with. That's getting a mortgage with one of the big five banks: CIBC, BMO, RBC, Scotia, TD. I've gotten private money, which is the most expensive form of mortgage, and I've also did the B lenders. Every instance of my lending journey, I've required those. So there's always a way to get a mortgage on a property. So that's what we wanted to talk about today, and how that can really help you grow substantial wealth. So Amit, why don't you introduce yourself before we get deep into this conversation?
Absolutely, Alex. First of all, thank you so much for having me here. It's always a pleasure speaking with you. We've known each other probably 10, 12 years and been friends and trust each other implicitly. So it's my honor to be here, and thank you so much for that. My quick background is I am a chartered accountant turned mortgage broker. So I find that to be a semi-deadly combination for the banks, because I'm able to explain to them things that sometimes that they may not understand. So whether it's self-employed people, employed, strategy, investment, everything from tax advice all the way to mortgage advice, we can provide that. So thank you for having me here, and I appreciate that. You touched on a good point. So everyone gets a mortgage, and the first misconception I find in the marketplace is everyone thinks that there's only five banks in Canada: TD, Royal, BMO, Scotia, CIBC. It's not true. We deal with almost 40 different lenders, and they range from, you can categorize them or you can give them their titles. They range from AAA, also known as Tier 1 chartered banks. Those are the banks with mortgages and loans and safety deposits and visas and credit cards, all the way down to private lending, which is, hey, Mr. John Smith, can I borrow $1 million? I got to give it to Jane Smith. That's what private lending is. But the key is what's in the middle. In the middle, there's A minus lending, B, C, but the names of that aren't as complicated. So, AAA is easy, the big five. Then followed by that, the A minus are some of the smaller guys like Tangerine, ICICI, MCAP, RFA. There's so many names out there. And then after that comes what I call trust companies. So most people know that TD Bank used to be TD Canada Trust. The difference between a trust and a bank is they can follow a different set of rules. So B lenders is actually what I call trust companies. And so the difference with trust companies is they're more common sense lending. They're what lending was like in the early 2000s in the early 2010s up to about 2013. And people get hung up on the type of bank, but at the end of the day, if it helps you become an investor from property 1, 5, 16, 20, 30, we've seen it all. I mean, if you're buying your 31st property, just be happy that you're able to buy your 31st property, right?
Yeah, and that may be mind blowing to some people on here, but you can get to that level. And I just referred someone to Amit today, a self-employed individual growing his portfolio. And what happens when you're growing a larger portfolio? Let's say you start at your local branch down the road. Well, that individual typically that you're dealing with is doesn't have the skill set to guide you on how to build a properly financed portfolio, when you get beyond one to two, maybe three properties. When you start getting to the four to five, um, they don't know what needs to be done. They don't know that you can stick handle through these different things. And Amit, being having the flexibility to go through different lending options, experiencing different scenarios. I think one of the biggest thing that's important is what banks like that at that time, what the flavor of the week is, let's say, right? So sometimes Scotia likes something more, sometimes CIBC likes something more. Why don't we just talk about a little bit about that, and how in the back end underwriting, how some of that works.
Sure. So the standard process is you have a client, let's call him John. He wants to buy a property. He's gung ho on, I got to get a mortgage at TD Bank. Okay. So I used to work at TD Bank. That's a fact. I started my career out there about 12 years ago. When you're dealing directly with a bank, there's nothing wrong with that. At the end of the day, you're at the hands of the person that you're trusting. But when I was at the bank, the issue was the toolbox that I have is limited to simply that bank. So if I got 10 clients a day, I could only help four of them or five of them because the other six don't fit into the bank's parameters, which is called underwriting. They underwrite the file. They make sure that what is being presented is accurate, that the income is accurate, the down payment is there, there's no issues with the file, that the house exists that's being bought. There was a time, I think 2006 or 7, where there was a story about like 40 houses getting a mortgage that didn't even exist. And that's what underwriting is there to prevent fraud. So by being, and it doesn't have to be a broker. I'm not here to promote myself and say you got to work with me or whatever. As long as you have access to various lenders, you can get the advice that you need that each bank can do. So one clear example, when you're buying an investment property, the number one challenge is, okay, can I use the rent from the property as part of my income? The answer is yes, no, and somewhat. Every bank is different. Some banks use the full $1,000. Some use half of it. Some use none. Some use the full rent minus the full expense. Some use the full rent minus no expense. So by having the toolboxes of each lender, we're quickly able to say, okay, does John fit at HSBC? No. Does he fit at Desjardins? Yes. Does he fit at TD? No. Does he fit at Scotia? Yes. Does he fit at National? Maybe. So what I do is I look at a client's circumstance and then figure out which bank fits them, as opposed to if you walk into a CIBC branch and they say, we'll try, we'll send it in. Well, they don't know what they're doing because they don't know that you fit for sure. Whereas I know exactly, or if you're talking to five different banks at the same time, someone will be able to say, yes, you fit our policy. It's not a matter of concern, it's a matter of time. So I think it's very important to be concrete in that.
And also, the if you're growing a larger portfolio, the order of the banks may matter as well, because
Absolutely.
banks will start capping you on how many mortgages you get, but different banks look differently on how, if they include other banks' mortgages or if they don't include other banks' mortgages.
Nailed it. So some banks allow you to have five properties total. Doesn't matter if there's a mortgage on them, doesn't matter if you signed it with your parents or your brother or your sister. Some banks say we will do for more, regardless of how many you have. Some will say we'll do 12. Some will say we don't care what you do, we'll lend you maximum 1.5 million, doesn't matter if it's on two properties or 10 for 150,000 each. So every bank is different. So what is interesting is once you cap out at the big guys, right, the TDs and CIBCs, There are limits anywhere from 5 to 8, sometimes 10. It really depends on the client and the bank, but 5 to 6 guaranteed, and after that it becomes gray, and then after 10 it's completely closed. So then people say, well, how am I going to get property 17, 18, 19, 22, 23? Well, that's where the trust companies come in. They like doing 3 or 4 each. Well, there you go. You do 4 with one trust A, then you finish those, then you do 4 more with trust B, and there's about 13 different trust companies in Canada. And people don't even realize there's even one, let alone that there's 13 of them. So yes, the whole process is possible, and I think the most I've ever done is like maybe 43rd property for a client. It takes 43 times as much effort, but that's what we're here to do, right? Because that's what it takes to help the client.
And that goes back to the original monologue opening. Time and real estate, two finite items, can build substantial wealth. So, how does it build substantial wealth? Well, how we were all raised is you buy your house, you pay off the mortgage, and that's it. But that's only one property going up in value. So, what if we started taking multiples? What if we had 2 properties going up in value? What if we had 3 properties going in value? What if we had 4 properties going up in value? Well, look at this investor that you had 43 properties. So now let's take 43 times time. Wow. Wow. Now we're getting exponential level growth. Things are getting that you're building big time wealth. And now what you're doing is you're building your own pension fund, and you're also building a generational wealth asset that can be passed forward. When you look around the world, like some of the biggest landholders, well, let's use China for example. China, you don't actually own any real estate. You own a 75-year lease. In England, if we go to England, it's the royal family that owns all the land, and again, you're on land leases on those. These are institutions that have accumulated real estate, leases the real estate back to individuals, but they still maintain the ownership of the land. So if you're able again to start accumulating your assets now, taking advantage of that time aspect, you can really set yourself up extremely well for the future. You can set up your family well for the future, because guess what? One day, if we're looking at yourself, one day your mortgage would all be paid off, probably in 30 years if we're just doing 30-year amortizations. And then when we apply a rate of return on that, that's your retirement income. When we've done a video on that, the cash flow offset method, where I show people how you can build $24,000 of pension income per year with today's purchasing power, just by buying cash flow positive townhomes in Calgary, for example. It's an incredible thing, time and land combined together. Yeah, go ahead, Amit. Oh, there we go.
Canadian statistic. Hello?
Yeah, we're good. We're good. We got you.
As a Canadian statistic is 90% of Canadians, when they retire, their single largest asset is the home. Most people don't have, let's just use a number for example. Your net worth is $1 million, but the home represents 900. So you have another 100K in RRSPs and other things. So like you said, why not replicate it? Because if 25 years later, when you're 65, they've both been paid off because they're on 25-year mortgages. Well, guess what? There's $2 million of net worth between 2 homes at $1 million, which, if you run it like a business, you had a tenant, which is your customer, pay it off for you. I mean, how much easier does it get to that? So then the question of challenge becomes well, why isn't everybody doing this? Well, the reason everyone doesn't do it is you have to be diligent. You have to have the down payment. You have to save the money for the property. You have to be patient, which is something we have seen time and time again. And then what happens? Okay, so it's 2010. We bought a condo for 300. We scrapped together 60 grand. Stretched ourselves. 5 years go by. Now that condo's worth 600. You go back to the bank. They give you the money. Well, guess what? You now have $250,000 because the bank gave you free money. And just to throw in a tax nugget, that money's tax free because you're only responsible for taxes when you actually execute a sale, or disposition is called, right? So you just keep replicating and replicating and replicating. So it's time, like you said, patience.
Yep. Real estate is not a game of instant gratification. You only lose money in real estate when you sell, so never put yourself in a position when you have to sell. But if you play the long game, it's long and boring. You can build that substantial wealth with real estate. And again, you've set yourself up for the future, taking that time and taking advantage of the assets. So you brought up a key point talking about getting the down payment. So let's say you own one property or you've owned two properties. You can then you can do a refinance if you own two and have one investment property, or if you just have your principal residence, you can, and we hear this a lot in the news, you can take your home equity line of credit out in that property. So if you're anywhere in Canada, your property has gone up in value over the last year. Well, as Amit said, it doesn't matter because you're gonna have to sell it to access that money. Or if you take a home equity line of credit on that asset and then invest it in something else that is going to cover off on that cash flow, that's how you start doing the multiplier effect. And that's why I wanted you on on our first podcast that we're doing and video series now on this. Right here. Don't forget to subscribe to YouTube, Alex J. Wilson. I wanted Amit on first because you need the mortgage component to do everything I'm going to teach you across all the rest of our episodes. But Amit knows what he's doing. He focuses on investors, and that's why I started the whole video podcast off and asking the question, who can get a mortgage? Everyone can get a
Everybody.
mortgage.
Everybody.
Everyone can get a mortgage. And the advice I give people, because I for the most part only buy pre-construction properties, uh, is that I evaluate my portfolio every year. I'm like, okay, well, what mortgages will I have coming up? What closings will I have come up? Because if you give Amit or your mortgage broker, your bank enough time, you can figure out any problem. Any problem can be figured out on for a closing that's coming up, if there's enough time given to the file. So key tidbit number one is just reevaluate your portfolio every year and how you're going to set yourself up for the next closing that's coming up. Because the great thing is that if real estate goes down in value, it's always going to go back up. And when we apply that time value on that, we see substantial results. I'm going to include some links down below where I show people example how you can build your own pension fund with real estate, and how my portfolio is going to be worth $21 million as it stands right now in with today's purchasing power in 30 years. Everyone listening, everyone watching video can do this. I'm from a small town in Northern Ontario. I saw this growing up. I saw the Mazookas in Capreol that owned shopping malls and real estate in my town, and I'm like, wow, look, they're the kingpins of this community. Why can't I do it, and why can't you do it? And with the waves of immigration that are coming, we're going to continue to see pricing going up. Another item I want to bring up, Amit, and we get this a lot, is people start getting worried about the stress test. Oh, what about the stress test? Do they need to worry about the stress test?
No. The reason is, let me try and layman it. So prior to 2017, let's use our example. You got John. John comes to us and said, "Hey, I want to buy a house." I said, "Okay, John, what's your income?" He tells me it's 100 grand. Okay. Prior to 2017, you could afford 10 times your income as a mortgage. That's prior to 2017. We're talking almost 4.5 years ago, about to be 5. Okay. So in 2016, December, John could get $1 million mortgage. Then the stress test came in from the government because the market was overheating, blah, blah, blah. Long story short, they've cut that down to 5 times income. So John now, who could buy for $1 million, can now buy for 500 grand. So that is the standard going forward. And it's been that way for 4.5 years. And if we look at the market and the trends, market has still been going up and people are still buying and everything is still going probably at the same speed it's been going the last 20 years. It's been a bull market for 20 years. So the question, will the stress test hurt? No, because it's proven that it can't. What has changed is people's approach to buying real estate. They're either buying more smaller units or they're buying jointly with someone or they're partnered with someone. So to me, the answer is no. I don't think it has had effect on real estate.
Where I wanted to go with it, and I'll kind of guide you a little more as well, is that the stress test isn't applied to your whole blanket of properties. It's individually, correct?
That is
So
absolutely
yeah,
true.
yeah. So
It's to the current purchase.
correct. So why don't you walk people through that? So they're concerned, they buy a house, they're like, oh, how am I going to get another property? Talk them through that point.
Okay, so let's say you have John who's got four separate properties, and
Mhm.
he's got four of them that have closed already, and he's like, I need to buy number five. Well, properties one through four, we call that a wash because those are already supporting themselves and taking care of themselves. That has nothing to do with the stress test. The stress test is going to focus on property five, which you're buying today, and the rules apply to that property specifically. That is what the stress test is about. Now, the news is full of, oh, the Bank of Canada did this and did that. So the stress test, again, to keep it simple, is based on an interest rate of, call it, 5%. So they reduced it to 4.8 or they increased it to 5.2. That only makes a difference to your mortgage power of 5% or 10%. So if you could afford 500 grand before, now you can afford 480 or you can afford 520. It's made a bigger deal than what it actually is because it's just some news to report on. That's my opinion of the
Yeah.
stress test.
And also the lenders you work with, the not every lender has to abide by the stress test, because some of your lenders aren't under that legislation, correct?
That is correct. So gospel of the AAA tier one banks. But for trust companies and A minus lenders, they have alternate products that don't require any stress test. It's what I call common sense lending. So again, every client situation is unique, but again, going back to the opening statement, everybody gets a mortgage, just depends which bank and what rate. So stress test is there, but it's not the end of the road.
No, there's always options for people, and you and I see it. Um, you have. I'll give another example. Let's say you have the small business owner, and but they like to pay themselves via dividends versus a salary. So they keep their salary down really low, and they pay dividends out. There are solutions for you out there, and Amit can help you with those. It's just that the A level banks are trying to put everyone. They have their idea of the person that they want, and they want to give the mortgage to. And back in the day, I know TD had a great. What was their program for self-employed individuals? What was that called, Amit?
The
Back in the
business
day.
plus, yeah.
Yeah, yeah. Now that doesn't exist anymore, right?
No, not anymore.
No. Um, but he has other people that do those kind of items that know that, okay, wait a second. No, you do have a lot of money. You're just not a T Ford individual that works at, let's say, let's pick a big company, Ford Motor Company. Just pick
Correct.
something that like, okay, you're not that, but you have a lot of assets. You just pay yourself in a more tax efficient manner. So if you're a self-employed individual, there's so many different structures that can be built for you to invest in real estate that make it advantageous for you. And you should be investing in real estate. Frankly, I'm a small business owner, and I take advantage of those systems and processes to maximize my wealth. Because again, there's no pension plan for you as a small business owner. So you need to build your own pension plan. Otherwise, when you lose the ability to work, well, how are you going to make money, right? So you need to start planning now. COVID's a great example, right? Like look at different businesses which were severely impacted. You can't plan for that. But if you had an asset base that helps you insulate yourself from that, then you're not as concerned. You can ride those rough patches. So that's why it's
So I
so
just want to
important.
jump
Yeah,
on the
go ahead.
business concept because and every time I get a call from someone who runs a business, whether it's a painting shop, a restaurant, a convenience store, a grocery, a laundromat, whatever, it doesn't matter, whatever the business is, right? So you made 100 grand last year. Cool. Can you prove it to me? No. I get paid cash. I make deposits. I did this. I did that. My income is low. Okay. So how much tax did you pay last year? I paid like my accountant was smart. I paid like 500 bucks. Okay. So let's keep that number in our mind. Let's call it even $5,000 of tax, just to multiply it by 10. So you have a person who made 100 grand and he paid 5K in tax. Well, if he worked at Ford, like the example you were giving, he would have paid 22,000 in tax. So now he comes to me and says, I need to get a mortgage. And I say, look, you're not going to get a mortgage at TD or BMO or RBC or Scotia. It's not going to work. They just you don't fit in their box. So it doesn't work. But I can send you to a trust company. Oh, I don't like trust companies. I heard their rates are higher. I heard this. I heard that. Well, first of all, you only hear about the bad experiences because those are amplified 10x for every good experience that you don't really hear about. So you get a mortgage for $1 million. It should have been about 3,500 at TD Bank. Instead, at the trust company, it's 4,000. So the difference is 500 a month. Okay, so that costs $5,000, $6,000 extra a year. 500 times 12. So now you saved $17,000 in taxes, and you still got a mortgage, which is only costing you a little bit more. So as a self-employed person, you're still ahead. And that's the part that I have to take the time to explain because you don't want to pay the tax on your income and you want the mortgage rate of someone who does pay tax. So you can't have your cake and eat it too. So if you're paying less tax, no problem. Let's just pay a pinch more on the mortgage and you can still be in the same position.
And specifically for investors, guess what? That extra interest expense is a tax write-off.
Right off.
So,
That's
so,
correct.
so you continue to reduce down your tax levels because you're paying an additional interest expense. I love that example, Amit. That is a fantastic example because it just you got to look at it a whole big picture, right? And usually when you talk about the bad experience individuals, those are individuals that are going to trust companies because they're more damaged credit or they got themselves in a situation. It's not the seasoned investors that know the value of being in these situations, and we have mutual clients that are using trust companies that are happy with them because it has allowed them to rapidly expand their real estate portfolio. And it goes back to that concept going, hey, I could own one property or I could own 10 properties. And I'm much better off owning 10 properties going up in value than only having one property going up in value. And then I'll also add this for everyone. And we talk about new Canadians. We're going to have big, massive waves of immigration coming up. We need those. We're an immigration based economy. So those individuals, they have to play catch up to everyone else because they haven't been here as long. So they're looking to rapidly expand their real estate portfolios, and this will lead to further price increases in major markets across Canada. We're coming up to time here, Amit. Is there anything else you want to add to this conversation? And also, I want to add that Amit's also a real estate investor himself. So you want to be aligned with someone that walks a walk and talks a talk and puts their money where their mouth is. But anything else you want to add?
It feels like we've only been on the chat for like 5 minutes, so time does fly. You know what? I think, from a consumer perspective, you don't know what's possible until you talk to someone like yourself or me. And after hearing what is possible, if it's for you, great. If it's not, then time is the test of what can come. In terms of what to add, I think the real estate market is like the stock market, or it's like weather, right? Weather is the day-to-day change. It could be cold one day, it could be hot one day, but we all know in the long run the earth is heating up, and that's climate change, not global warming anymore, because some places are getting cold, some places are getting hot. So real estate, same thing. It can go up in a quarter, it can go down in a quarter. That doesn't mean the market is collapsing on itself. you look at the long-term trend of a major city like Toronto, we will always be behind New York by 10 years. We will always be right on the heels of Hong Kong and London. We have everything to offer the world. We have probably better weather coming. We have the land, we have the space, we have the culture, we have the restaurants, we have the industries. We're not like other parts of Canada, like BC is very natural resource based and Alberta is petroleum based. And, we're not like China is manufacturing mostly and India is IT. We're like the US. In Toronto alone, we have mining, banking, IT, infrastructure, building, homes, builders, developers, Menkes, Mattamy. We are so insulated that I'm not here to say that Toronto's going to go up every day, but over a 25-year time frame, it is going to be just like the stock market. It's just going to rise. And I think I've learned this from you, so I'm not going to take credit for this comment. And the world population is headed towards 10 billion. Those 2.5 billion people got to go somewhere. So if there's 1,000 global cities in the world, and 2 billion people got to go somewhere, that's a lot of extra people per city. So there is not enough supply to meet all the demand. That's what's driving up the pricing. So between the zoning rules and the demand and the lack, you would know better than me, the builders are smart. They build exactly what's needed. They don't build more or less. So it's all managed. So I
Oh,
mean,
yeah. Yeah, so many different upcoming podcast episodes that we're discussing, and I'll end with that last one there, just talking about builders. These builders buy up inventory for 25 years. They literally look down at Southern Ontario, and they
yeah.
go, okay, I can see where the trends are going. I'm going to buy up this land. And they're just going to hold it and they'll develop it in 10, 20, 25 years.
They'll
But the
develop it
key,
for our grandkids. It's not for
exactly, yeah.
us.
Yeah, yeah.
Yeah.
They're attaching their names to it. So I want to finally say that everyone, as Amit says, can get a mortgage. And if you apply the principles of finite time and a finite resource like land, which is real estate, you can build real wealth through real estate. And I want everyone to subscribe to Alex Wilson, YouTube.com. Alex J. Wilson, that's what you're going to search. And also on the podcast, Real Wealth, Real Estate with Alex Wilson. We are going to show you how you can build that financial freedom, generational wealth, a $1 million plus, multi-million dollar real estate portfolio. And every week we're going to be bringing you new content, showing you how to do it. No seminars, no paid seminars, everything. Just honest videos that show you how to do that. And thank you so much for taking the time. Alex Wilson, Remax Wealth Builders, real estate broker owner. My portfolio myself right now currently is worth $14 million. And we have my mortgage specialist that helps me with all of that, Amit Puri. You'll see his contact details below. You can reach out to him to learn how you can start your journey, because you do need mortgages to make this a very profitable venture. So thank you, everyone, and see you next week. Bye-bye.
Thank you.